Everywhere you look, a pace. Driven by the explosion of artificial intelligence, tech stocks have climbed higher and faster than almost anyone anticipated. Everywhere you look across retail investing communities, you'll find supreme optimism. Social media is flooded with fast money stories, risky trades, and an overwhelming sense that the market only goes in one direction. But while everyday investors are experiencing maximum euphoria, a very different reality is playing out behind closed doors. One specific detail is starting to make Wall Street extremely nervous. Warren Buffett's Berkshire Hathaway, the most famous buy and hold institution on the planet, is quietly sitting on nearly $400 billion in cash. This animated scale shows exactly what that number looks like in reality. A $400 billion pile easily eclipses the entire economic output of several nations. Keep in mind, this is a man who has spent decades studying market psychology. He has successfully navigated and survived massive market crashes, deep recessions, and historic economic bubbles. If the most successful long-term investor in history refuses to buy into this growth, it suggests a significant disconnect between current prices and actual value. Berkshire Hathaway moved toward a deliberate liquidation of their core holdings, shifting their focus away from new purchases. Through 2025 and into 2026, under the leadership of CEO Greg Abel, the company's strategy shifted into an aggressive defensive posture. Reports showed massive sales involving heavy-hitting tech and retail titans. They slashed their positions in absolute giants, including Amazon and Apple. They also reduced their exposure to the bedrock of the financial system, shedding shares of Bank of America, Visa, and MasterCard. This chart highlights the severity of the move. For multiple consecutive quarters, Berkshire Hathaway operated as a net seller of stocks, with their sales violently outpacing any new purchases. This level of sustained selling across various sectors represents a calculated retreat from the market, signaling a lack of confidence in current price levels. The primary mechanism driving this retreat comes down to a single metric: market valuation. Look at this graph demonstrating the valuation gap. Extreme investor excitement pushes asset prices dangerously above their fundamental worth. When that spiking price crosses his safety threshold and the math no longer supports the hype, he pulls his chips off the table. Compare that strict discipline to the behavior of everyday retail investors, who often ignore the underlying data to blindly chase rising prices. When stock prices detach from economic reality, holding cash serves as a mathematically sound defense against a potential collapse. This entire strategy hinges on the profound psychological philosophy that built Buffett's empire: be fearful when others are greedy, and greedy when others are fearful. Today, that greed is visible everywhere. The fast money boom and speculative trading represent a peak in modern market euphoria. In direct contrast, Berkshire's record-breaking $400 billion cash pile stands as the physical evidence of extreme caution. Online investing communities are actively debating what this means. Is Berkshire predicting an imminent catastrophic crash, or simply hoarding a massive war chest to buy cheap stocks later? The truth is, the distinction doesn't matter. Both scenarios confirm that the smartest money in the room views current market conditions as far too dangerous to touch. Buffett's true genius has never been predicting the exact date of a collapse. His power lies in possessing the absolute patience and discipline to survive periods of extreme uncertainty. That $400 billion is a massive financial shield, and if the greatest investor in history is quietly bracing for impact, can you afford to keep chasing the hype?